But the Kenya Kwanza administration to increase the tax to GDP ratio will see the administration squeeze Kenyans further. In the budget statement, the Cabinet Secretary, Professor Njuguna Ndung'u, proposes that through the implementation of the medium-term revenue strategy, Treasury will be able to expand the tax base to 20% of GDP over the medium term, increasing it from the current percentage of 15% to GDP in the 2024-2025 financial year. According to Deloitte, this will see Kenyans squeezed for an additional 1 trillion shilling tax revenue between now and 2027. We get more from our very own Jimmy Mbogo.
Hours after the Cabinet Secretary for the National Treasury, Professor Njuguna Ndung'u, laid out the fiscal policy for the coming financial year, the implications of the policy continue to gain clarity among Kenyans. Among the recommendations by the CS was the plan to increase domestic revenue mobilization in the medium term to 20% of the GDP in the next 3 years.
We shall implement a combination of tax policy and administrative reforms. The reforms are premised on the need to ensure that taxes are more supportive to economic activity. They do not distort the market and have a predictable tax structure. The reforms include, first, implementation of tax policy and administration measures proposed in the Finance Bill 2024. Second, implementation of the medium-term revenue strategy to expand the tax base to 20% of GDP over the medium term.
According to Deloitte, the move will see the government squeeze an additional 1 trillion shillings from Kenyans in revenue. With the tax bracket remaining the same, Deloitte fears that salaried Kenyans could further bear the brunt of the additional burden.
That means they are going to be coming back to the same taxpayers to raise that money, and a 5% increment is not a small amount. It's over 1 trillion shillings in extra taxes. So you can project what you are going to be required to pay over the next 2 or 3 years if the government wants to collect an extra 1 trillion shillings from the existing taxpayers.
Although Deloitte admits there could be scope for the government to achieve its intended target for taxes as a percentage of GDP, they remain bearish on the government's ability to find innovative ways of widening the tax bracket, and with the Revenue Authority failing to meet its revenue target, the easy-to-target sector remains exposed to additional tax measures.
What we are doing is we are taking more from the existing taxpayers. So if you are paying tax of 20-30%, now you're going to be paying 40% if you add the levies and all that. So we are taking more from you and diminishing your net or disposable income. The challenge we have is we probably don't want to do the hard work of targeting what we call the hard-to-tax sector.
The government itself seems well aware of these challenges.
There is an existence of hard-to-tax sectors. The economy is dominated by a large informal sector that is mostly outside the current tax instrument, leaving the country to rely on a narrow tax base, and it is time to reverse this trend. Second, proliferation of tax expenditures over the years. Tax expenditures are estimated right now at 2.9% of GDP if you consider the 2022 data. That it has major erosion to the tax base.
Kenya currently trails Rwanda in the block, with Rwanda's tax to GDP rate standing at 17%. However, Kenya at 15% is still ahead of Uganda and Tanzania at 12.2% and 11.8% respectively. Should Kenya hit the 20% tax rate to GDP, it will join South Africa and Morocco with some of the highest taxes in the continent. According to data from Deloitte, Morocco's tax rate stands at 27.1% of the GDP, with South Africa standing at 27%. Jimmy Mbogo, Citizen TV, Nairobi.
At the same time, the cost of